Good afternoon, ladies and gentlemen, and welcome to our webinar today. Remember, this is one of the webinars that we will do on Thursdays, every Thursday, apart from last Thursday. Remember, we were just around our Easter holidays. Hope you joined your Easter holidays, by the way. So welcome, and every Thursday we have these webinars, and for today we want to look at fear of missing out. What is FOMO in trading, and how can you overcome FOMO with a trading plan? Make sure that you join with audio. Check out your audio, make sure you can hear well, and make sure as well that you can see the screen. If you have any questions, don't hesitate to ask towards the end. You can type it on your control panel and we will look at them towards the end. And let's proceed. So what is FOMO? It is the fear of missing out. FOMO is the fear of missing out. F, fear, O of M, missing O out. So fear of missing out. It is the excitement of missing a trade opportunity in the markets. Yeah, like you seeing the prices trading upwards or downwards, and if you're not in that trade, you feel that it's like you're not getting what you should be getting. For example, you're not in the market when others are there. So it's a desire to experience success of another trader in a trade which is not part of your plan, right? This one means that you have a colleague who is in a trade, for example, they're getting profits, right? And you did not get that opportunity because it was not part of your plan, for example, it was not part of a trading strategy. So the feeling that you are not experiencing what that trader is experiencing, that one is fear of missing out, the fear of regret of missing an opportunity. You're fearing that if you don't get into that trade, maybe buy or sell, just like your friend is doing, or like everyone else in the market is doing, you're going to miss out on that opportunity of making a profit. That's fear of missing out. And if you experience that fear, it influences you as a trader to chase the market. So the market is already trending, it's on an uptrend. You didn't enter the right place, but you have colleagues and you have everyone in the market, or maybe other people in the market who have taken that opportunity. The price is already trending upwards or downwards. So a trader who is suffering from fear of missing out is likely to start chasing the market. You want to catch that trend, so you go and enter at an inappropriate place. So you realize that FOMO traders will buy near tops, right, or sell near the lows. So immediately you buy near a top, the price might trend upwards a little bit and then it starts falling all over again, right? Because you are chasing the market. So this is a problem that both experienced and novice traders can experience. Of course, it depends with the level, right? The effect might vary depending with how the type of a FOMO trader you are, right? We have traders who will experience FOMO such that they will enter the trades late and get out with a very small amount of money, right? And there are traders who will just get in without knowing what they're doing, just because they're experiencing, they are hearing that others are getting profits in the markets, right? So both experienced and novice traders can fall into FOMO. So what matters is, are you able to control? Because if it's not controlled, it leads to other emotions like excitement, impatience. Excitement in this sense that everyone, maybe you're in a group, for example, and everyone is talking about a certain currency in a very big uptrend, or certain currency strengthening because of certain news. So you feel the excitement, you want to get in as well and trade. Yeah, it's out of it's fear of missing out which is causing that excitement, right? Impatience. You have a trading strategy, it has not given you a signal, for example, to enter, right? Because we have got different trading strategies in the market. So you're not patient to wait for your signal based on your system, because someone else is telling you that, well, they're in a very nice trend, right? So FOMO, if you fear missing out, you get into being impatient again. Greed. Just because someone is getting profit doesn't mean that you will as well get it, right? Because that's based on their system. It's based on their system. Is it based on your system as well? such that any market movement or any market pattern, it can give you an opportunity, yes, all right, but it's not the end of that market. The market is there. So if you miss an opportunity right now, doesn't mean that you can't get it in the next maybe one day or another time. So fear of missing out brings up the greed such that um, you want to think it's like this opportunity won't appear again. But this market is here, all right? No one is going to take it away. So you need not to have greed, fear. FOMO again brings up fear, all right? That well, they're not getting this profit right now, then there might be no other opportunity. Maybe I don't know why someone would get into fear, right? But these emotions, excitement, impatience, greed, and fear, they are all coming out of that regret of missing an opportunity. It makes a trader fail to implement a trading plan, and it's something that we need to look at. What really causes it? Number one, we have dependency. You're depending so much on someone to tell you what to do, right? Or depending so much on signals given by someone, for example, depending so much on as a given group or someone to tell you what to do, right? That one will cause you to feel the excitement, right? The excitement of missing out when your your advisor or the one who gives you the signals doesn't give you in time, right? How do you avoid it? You learn how to interpret news and analyze market independently. Learn how to depend on yourself, how you can interpret the news, how you can analyze the market independently. I'm not saying that you should not listen to someone else or get signals. Yes, you can get signals, but make sure at least that you have your own opinion first, so that whatever you're getting from someone else is just a confirmation. You're not blank. You're not fully dependent on someone else to give you, to tell you what the market is, what's happening in the market. Of course, you can see it. You have the platform. You can see the movement of the charts. You just have to take a little bit more time to understand how they go. Another thing which will make you to fear missing out on something or feel like you're missing out on something is lack of objectives, or you don't have goals in your trading. Okay, what do you want to achieve? We have traders who will maybe get a very nice setup. You have a trading strategy, you have a very nice setup in your charts, and then you get a very good trade and you make a profit maybe of $5 or $10 depending with how you trade, right, and your target. So if, for example, in a day you were targeting to get only $5 and you got your $5, right, and you get your $5, are you going to be satisfied with that, right? And now that we're talking about $5 target, do you already have an objective? Are you looking for one to get $5, or are you looking for one to get as much profit as the market can offer? Remember, this is the market moves in cycles, right? It moves in cycles. In trends, you can have an uptrend, and in the next minute you have a downtrend. In the next 1 hour, you have another uptrend. So the market is cyclic, right? Someone raising a hand. The market is cyclic. So if you have objectives and you know, like in this trade, I'm targeting like just $3 or 15 pips, and you hit it in a day, then of course you're not going to feel like you're missing an opportunity when someone else who might be having different goals is riding a bigger trend and making profits, or maybe in another trade, right? So when you lack objectives, when you don't have goals in your trading, you're likely to feel the excitement, to feel like you're missing an opportunity somewhere, right? Because you didn't have a goal of how many trades do you want to have in a day, how much are you targeting, what is your risk reward. So you must have goals. If you don't have goals, it is likely to lead you to feel like you're missing out on an opportunity, right? Insufficient knowledge. Someone is not likely to come and tell you that, well, we have big news on this and certain financial instrument is trending so much. If you know yourself how to watch out for that, all right? When you have the knowledge on how to check out on that information in the economic calendar, for example, you can filter out the big impact news, right? And you know this news, which financial instrument will it affect? Then you're safe because you have sufficient knowledge, right? Do you know what you're in for? For example, when you started trading forex, did you take time to learn and get the education, and in the process know what you're really in for? Okay, are you really missing out on anything, or is it because you don't know? So if someone comes and tell you that, the markets are moving and it's time to buy, what are you buying, for example? And even as you're buying, what are your targets? Maybe someone is telling you're supposed to be buying a certain financial instrument and it's not yet been confirmed. Right? The setup in the market does not confirm, because it's always good if you have the knowledge of when should you be buying, when should you be selling, and which is the best point for you to buy or sell. So make sure you get sufficient knowledge, and that will help you to avoid the fear of missing out, because you might be getting the excitement of missing out on something and it's actually nothing that you're missing out on. When you have knowledge, you won't get such influence. Another thing is impatience. Wait for the market confirmation. If you have a trading strategy based on maybe moving averages or whichever strategy you have, right? Maybe you're looking for the price setups or the pin bars and all those for the people who use price action. Be patient. Remember, you might be on an uptrend, right? On an uptrend, you're looking for opportunities to buy, for example. On a downtrend, you're looking for opportunities to sell. So you're like three traders, and one trader is waiting for is trading using maybe uh, uh, waiting for a pullback and then enter the market after that, right? Someone else is waiting to see certain Fibonacci level has been attained, right? Someone is trading on supply levels, but you're on the same uptrend, all right? One will get an entry before the other. Okay, so if a trader, for example, who is waiting for a crossover and then is waiting for more confirmation, for example, on the candlesticks to maintain above the fastest moving average, is likely, or she is likely to wait for a little bit longer. Okay, maybe someone who is waiting for the price to who is trading on a different time frame, like on a higher time frame, they have to wait for a confirmation a little bit longer than someone who is trading on a 15-minute time frame. So that if your trading, if your trade setup does not show up, you have to be patient. Wait for the market confirmation, right? Someone might be the same financial instrument, they have got into a trade, but then you have not yet got your signal. Wait up until you get your signal, because that's what you trade, right? So don't be impatient, because if you become impatient, you're likely to start feeling like you're missing out on something, when you actually are not missing on anything. It's just because you've not waited for confirmation. All right, so trust your system. Missed trading signal. Something else here. If this market is there, I don't know how many times I've mentioned this one several times, and I keep on insisting. If you miss an opportunity today, the market is not going anywhere. If you miss an opportunity this week, you've made losses this week, next week, the market will be open, right? Don't lose focus. If you miss a trade right now, maybe you didn't get the signal at the exact time you're supposed to enter. Of course, we have got other businesses that you're doing, right? And obviously, traders try to multitask. You're doing something else, and trading is part of your side hustle. You missed a trading signal. It is not the time that you feel you have missed out and it's like the end, and you were targeting such a big profit today, you've missed out. Let this one not lead you to a mistake of trying to chase the markets. All right, don't chase the market. The signal is gone. Yes, of course, you've missed out on that opportunity to get that, to write that profit. You have to accept that. All right, but don't have that excitement that I'm missing out on a very big opportunity in the market. Like I should catch it, I should not let it go. Sometimes you have to accept to let it go. Live to fight another day, right? If it's a missed opportunity, let it go. And it's always better to not find yourself entering the market too late, and then immediately you enter, you have the price reversing, and now you in profits, you in losses. Sorry, that's the point where you hear traders complaining, especially the ones who are starting. They're complaining that why is it that anytime I enter the market, I buy? That's exactly when the price reverses. Well, the reason is because you're catching the trend on its tail, right? You missed the trading signal. Maybe you do not have a good system to help you enter the market at the right place. So how do you avoid this situation of missing out on a trading signal? Use pending orders. If it's something you are waiting for, and maybe it's before before that level is attained, use a pending order. Set the opening price at a certain level, set your stop loss and take profit. And if those levels are attained, when you're not even when you're maybe doing something not on your screen or on your phone, it can be taken for you. All right. Set alerts. You can set alerts in your desktop, and you can even get notifications, right? And they can help you to know at the exact point where you wanted to enter your trades. So if you miss a trade again, if you don't have the pending orders and set and alerts to inform you when levels have been attained and you missed a trade, well, there's no problem. The market is here. You can always trade it, right? Because if you don't manage that, then it is going to lead you to the fear of missing out. You feel like you're missing out on a very good trade. You want to catch the trade on its tail ends, and that's how you lose, right? So another thing is confidence trap. And this is mostly on people who have been trading and over time you understand your trading strategy. This is a problem with experienced traders. Confidence trap. You've been making profits before, but now you started losing. Okay. And you don't know maybe at what level should you start changing your strategy. You started losing, but maybe it's a very small problem you've not changed with your trading strategy, right? So it starts eroding your confidence again. You lose confidence with your strategy, which has been working before, and now you want to scrap it all. Remember, every strategy works. What matters is, have you taken time to really know the best levels that you should be entering a trade using that trading strategy? Have you taken time to test on various financial instruments so that you know this is a strategy I should be using on Euro USD and not on gold, for example? This is a strategy I should be using on indices like US 500, all right, and not on commodities, because different strategies will work differently on various financial instruments because they have got different aspects. For example, a gold is a little bit more volatile as compared to a currency like Euro USD, right? Which is a majors. So when you've been trading before and you've been making profits, actually, when you have already gotten a good strategy and you're making profits and it's working for you, that is exactly the right time to be caught up in FOMO, and your success spirals down again to a very negative thing for you, right? Because when you have a strategy, you have confidence in it, and it's changing, you're now making losses, you need to take time and readjust, right? Maybe you've started becoming greedy. Maybe you started breaking your own rules. Maybe you don't have a way of controlling your mindset, because mindset is very important. We'll look at it a little bit later. So confidence trap, make sure you can regain back your confidence. Go back and learn from yourself. All right, learn from yourself. What mistakes have you been doing? Because don't let yourself lose confidence again, and then you start depending on other people. Yeah, you lose your objectives. All right, you become impatient, because all these things that cause fear of missing out are like interrelated. Make sure you always study yourself. Know when is it that your confidence is getting eroded. When is it that you what is happening with your trading strategy? Are you already patient with it? Are you losing patience, right? Are you tending to depend on someone so much that you're losing the confidence of interpreting the news? So confidence trap, something dangerous. Make sure you can avoid all these things. And whether you're an experienced trader or you're starting up, these things will always keep on creeping into your trading. All right. Now, how do you overcome FOMO in trading? It's very important, even because at the beginning you're told to get the right education, understand how to trade, know all the financial instruments, know how to use the platforms, all those things. Always follow the market. Make sure you're trading based on what you see in the markets, not what you think will happen, but what you see in the market. That's confirmation. Yeah, you cannot just guess that just because you've got three candlesticks being bullish, and you tend to think that, well, this market will keep on going higher for the next 100 pips. No, you have to wait up until you get the confirmation in the market. All right, because information comes up and change everything. So that is knowledge, yes. But now something else very important is a trading plan. If you need to become a very successful trader, then you need to have a plan. There is this common saying that if you fail to plan, you're planning to fail. I don't know whether you can adopt it here, but you need to have a plan as well. You have a trading strategy, yes, of course, but you have a plan on how to implement it. A trading strategy and a trading plan is a little bit different, right? A plan encompasses or involves all those things that you're going to do to make sure that your strategy works. Other people will call it trading style, right? But just make sure that you have a trading plan, because when you don't have one, you're likely to go to losses, right? A trading plan is just a set of rules that guides you as a trader. There are people who would want, for example, you go out there and check out for trading plans. Someone will say that when they wake up in the morning, they want to stretch a little bit. You go to the markets, you start or maybe you take up, maybe before that you take a breakfast, for example. You check out your machines where they are working. You start checking out on the markets. For example, what has been happening on the Asian market. For example, here when we were here in Kenya, we wake up in the morning when the Asian market has already been closed, when it's closing up. So what has been happening on the Asian market? Where has the prices moved? All right. Check out on your system which trades look like, which setups are coming up. Okay. So, and up to that point, what else? That type of a plan on how do you go about your trading. Like you have a whole trading day ahead of you. How are steps going to follow through, right? Such that you are going to implement your trading strategy, right? That is what a trading plan is. There are others who are as well working and you're trading. How are you managing between your work and your trading activities, right? What do you do so that you don't miss out on these opportunities? That plan of how everything is running through in your trading day, that is a trading plan. And inside there you have a trading strategy, and all of this you can call it trading style, but this is what it means. Do you have a flow of how things should work out for you in your trading day? And key components in your trading plan are trading strategy. Of course, you must have a strategy. If you have a strategy and you don't have a way of implementing it, all right, being in the right shape, then of course it's going to fail. Do you have a risk management and money management? Okay, money management and risk management. Maybe I put money management here to try and mention something about your capital, your equity. It's also very important. Okay, risk management and money management, very important. Mindset. When you lose, how do you feel? How do you manage it? When you make a profit, how do you feel and how do you manage it? All these will go into your trading plan. This is where you have a system that you can always repeat over and over and over, and it works for you. And you always have to keep on improving it. Now, let us check out on a trading strategy checklist. We said we have trading strategy, risk management and money management, and mindset. Now let's start with trading strategy. With a trading strategy, you want to ask yourself, are my trades based on trend following, counter trend, range, support resistance, supply or demand zones, or maybe news or fundamentals? So all these are ways that you can form your trading strategy. Yeah? All right, you can form your trading strategy based on any of these. But now you have to be very specific. Okay, sometimes you cannot use all of, like for me, I can use trend, I can trade on counter trend, range, support, all these. But now I can't manage to do all this and remain objective. Make sure you remain objective. If it's trend following and you want to master it out and in a very easy way identify your trades, then keep to that. Okay, if it's news and fundamentals, have your system which is based on news, all right, and you have mastered it so well that you can easily implement it without struggling. Because another problem we have as traders is that in our uh, in our um, in our learning journey, we want to have as much information. We want to learn about support resistance, how institutions trade, like in the case of supply and demand zones. And by the way, we'll be covering more about supply and demand zones in I think the next week, right? Next week, Thursday, be speaking more about supply and demand. So you can maybe combine one or two of these approaches, but make sure that you stick to one. Okay. So identify a, a way that you're going to base your trading strategy. Is it trend following? Keep to that. Support resistance? Keep to that. Now, again on strategy, another thing is which financial instrument. Not all the trading strategies will work on all financial instruments. You need to assess yourself which financial instruments you like trading. We have got so many currencies, yeah, and those currencies are in pairs and different groups. Which groups do you like trading, right? Is it the majors, minors, or exotics, right? Do you like commodities? Which commodities do you like to trade? And do you understand that these commodities require you to have a little bit more capital, for example? Yeah, let's talk of silver. You need more, you require to have more capital, right? The required margin for silver is higher as compared to gold. Which one do you think is going to favor you? Stick to that. And are you okay? Are you risk, do you have a higher risk appetite? Because a financial instrument like gold will have high volatility, so that you can see a very fast change in price, right, over a short period of time. You assess yourself based on that. Yeah, are you good? Do you like trading in stocks currently, and are you good in following maybe the global financial news and all that? Because with indices, then it's trading a couple of, or a group of financial instruments, a basket of stocks put together, and it's their performance. For example, the tech the tech stocks, for example, in US, UT 100, which is the Nasdaq, or for example, are you trading independent stocks? Are you cut out to like follow all those, if this those financial news and trade with all this? And again, do you have that amount of, are you going to invest that capital, big capital? Because again, they've got uh, um, lower leverage, right? So all these things in your trading strategy, now that it's based on maybe trend following, and it's trend following now on which financial instrument, which currency. Okay, I'm leading you towards a way of building a trading strategy, because it's part of the trading plan. And if it's based on news for this financial instrument, do you have major news lined up for that financial instrument? Because you don't want to act before the news come up, otherwise it might come and surprise you. All these things, you put them together. Okay. And next, in trading strategy still, it has to be based on a given time frame. If not one, at least at most two. Okay, if not one time frame, at most two. We've got 5 minutes, 15 minutes, 4 hours daily. Again, do you want to, are you the type of person who want to see um, to have several trades in a day? Then you need to be on lower time frames, for example. So that's why you get the setups faster, or several setups in a day, like in 15 minutes or 5 minutes, right? But are you the type of person who will be waiting? You can wait for a single trade for several, maybe hours. Then you can go to 4 hours or hourly. time frame. So you construct your trading platform based on which financial instrument you want. We check out that one, and which time frame looks better for you. Which session? We even have various sessions. Is it the Asian session will be open to once at night, for example, quite active at night. You will hear some traders will say that there's a lot of volatility at night, maybe 2 a.m., 3, 4 a.m. All right. Yes, of course, that's Asian session. Do you like it? What favors you most? London session is from 10 a.m. of our time, East African time here, Kenyan time, Nairobi time, right? Is it the New York session? Quite active, and you have these times when they are overlapping, these sessions overlapping, quite active. Do you have time to trade at that time? And is your strategy based on which session? You need to be very specific. And these are the small details that you miss on your trading strategy, and it doesn't work. All right. So time frame, which session, all right, and is it towards the end of a session or the open of a session, or at the middle of a session, or are you going to trade during news releases? For the people who will trade based on news only. So having gotten your time frame, all right, which set of tools, which indicators are you using, for example? Or if you don't use indicators, maybe you're using pure price action. But with pure price action, again, you have to combine it with support and resistance or supply and demand levels. So your strategy has to include all these as well. Which session, right? Which time frame, okay? And you still have to note the time that the news is being released. Now, again on strategy, when do you enter or exit a trade? What gives an entry signal and confirmation? In your trading strategy, if you're using indicators, or even if when you're using, when you're just following the pure price action with the candlesticks only, you need to have a way of getting a signal and getting a confirmation, right? Just to make sure you get a very high probability setup. How much are you willing to lose on a trade? Very important. Where should you take profits or put the stop loss, right? Does the entry, stop loss, take profit set up a reasonable risk reward? Risk reward is very important. How much are you risking, targeting what in the market? This one is getting us back to the objective. What is your objective? Because sometimes you don't want to lose a certain percentage of your capital. If you have $100, for example, and you don't want to lose more than $5, you should have your stop loss at that level, yeah, such that if your stop loss is hit, you're not making more than the amount of loss or amount of risk that you're taking in every single trade. How do you manage your trade after entry? This one is leading us to, are you the type of person who will will enter a trade, it goes all the way to the profit zone, and then you wait again up until it goes to the losses? Something called trailing stop. So when to enter or exit a trade, and how are you going to manage your trade once you're in? Okay, this one also goes to your trading strategy as part of your trading plan. All right, something else now. Let me recap on the trading strategy. A trading strategy, you need to decide, is it based on trend following or counter or support resistance? What is your trading strategy based on? Then after that, which financial instrument is your trading strategy cut out for? All right, and for that financial instrument, which major news come up and affect it? And I'll give you an example. For the people who are trading with the US dollar, or financial instruments affected with the US dollar, or pairs that have US dollar in it, of course you need to be very keen on the non-farm payrolls. That is data for the US labor market. You need to check out for interest announcements. That's the FOMC announcements, interest announcements, or their stand on monetary policy. FOMC meetings, right? Also PMIs, right? So you need to note those important news for a given financial instrument that you're trading on. If you're trading on gold, you want to watch out for inflation news, again, on the side of the US. All right. If you're trading oil, you want to keep up to the news about OPEC, all right, and all those countries that are producing oil, supply and demand. What is happening with that? Okay. You cannot trade all the financial instruments. Trust you me. You can't trade everything in the market. You have to make up your mind and have a few, and then you become so good in it, in that strategy which you've formed. Now, select a financial instrument, know the news and the major events which affect it. Okay. Is the analysis based on the right time frame? For that financial instrument, which is your favorite time frame that will give you the best results? At most, have two time frames, right? Some people would want to combine maybe 4 hours and then check out for trades on the 30 minutes, or maybe 1 hour check out for the entries or manage your trades on the 15 minutes. So because if you take so many time frames again, it's going to confuse you, right? Or even if you can use it very well, then you're limiting your time to focus. Remember here you're using, you're trying to zero down or narrow down to a very simple way of trading. You can't keep analyzing the market from 5 minutes to 15 minutes all the way to 1 hour. And what you find on 15 minutes, you find an opposite signal on 1 hour, and then you're caught up in a confusion of you can't even place a trade. All right. Sometimes it's called analysis paralysis. You overanalyze the market up until you can't get anywhere to enter. So make a mind on which two maybe time frames, or maybe stick even to one, even better, and you keep with that. And if, for example, you have like 5 financial instruments lined up that you track their movements using your trading strategy. Of course, if you miss a trade on one, you would, or all the 4. Let's say, for example, you have 5 of them. If you miss a trade on 4 of them, you wouldn't, you would not miss on one. All right. So it's very important. Have the time frame. Now, once you have all that, you need to furnish on your decision making on where should you enter, where should you exit the trade. All right. And that is very important. You should have that solid trading strategy based on all those, right? Now, money and risk management. Remember, even if you have the best trading strategy, if you can't manage your money, if you can't manage the risk, then of course you're in for some failure, right? Here we're talking about the risk. How much are you putting into the market? So before you get started, make sure that you put up a list of rules to guide your money management strategies. And here are some questions that you should ask yourself on the risk that you take in the market and the money which you're using. When I talk about money management, I'm speaking about the money that you're putting there. And this one goes even all the way to whatever you're putting there. Remember, this is a risky market. You don't put your everything. If, for example, you have a million, yeah, you have a million, you would go and put all your money into trading, right? You don't want to do that. Same way you wouldn't start a business outside there with all that you have. You take a portion, okay, so that it doesn't excite you. So money management is very important. Know how much you want to invest of all that you have. How much money do you want to invest? For example, put in forex trading. If you have 50,000, don't go and put all of it there, right? As a very honest advice, right? Put a portion of it, but again, not too little, because again, if you put too little, you might not be very serious with it, and that one is likely to make you get relaxed, and you can easily lose it. So anyway, you have all the time to not focus on it. So you put an amount of money which is not too little that you feel is not quite important, right? Not too high that you have all your stakes in there. That's part of the money management strategies you have. So ask yourself, what is your startup equity and what is the maximum drawdown in that equity? If, for example, you've put $1,000 in your trading, $1,000 is 100K Kenya shilling. You put $1,000. How much can you afford to lose of that $1,000? Of that 100K, how much can you afford to lose in a single trade or in a single day? Those are the red lines that you're drawing on your equity, on your money management, such that if in your trading strategy, whether good or the way it is, if you're going to see in a single trade you make a loss of like $100 or $50 in a day, that day you tell yourself, well, I'm done, let me take a rest and I will take a trade another day. That is something important. I'm not saying you do so, but you need to have something like that. If you have $100 and in a single day you've entered a trade that's gone so wrong that you made maybe a loss of like 10% of your trade, like $10 you've lost in an $100 account, you should have a way of controlling yourself, because you don't tell me that you won't feel anything when you lose 10% of your capital. You should feel very bad, of course, and it's allowed. So when you feel so bad, you should know that one thing, you are losing your focus. So leave it. Okay, trade another day. The market is there. Live to fight another day. Don't go risking another amount of money, because now you're not even objective and you're likely to lose even bigger. All right. Don't be a gambler. All right. A gambler is a person who will, if you lose 10 shillings, you want to get some more 50 to follow up with that. No, have control. How much? What is the maximum drawdown that you can allow in a single maybe trading day or in a single trade? All right. Maybe what is your growth goal? What are you looking for in a day of trading, for example, or in a month or in a week? And this is the biggest question in trading. Actually, one of the biggest questions, not the biggest, we have got other very important things, but this is one of the biggest things, that this is what makes a trader or traders fail. I'll ask this question. All right. Be honest with yourself. I know we don't have that time to like catch up one-on-one and we speak about it, but I give these scenarios in classes, in one-on-one classes. Let's say, for example, you have got 100,000. You're starting a business. 100,000 is $1,000. Start a business outside there, maybe in your local town, wherever you are. How much are you targeting to get out of that 100,000 Kenya shillings business? If you get 1,000 a day, you're very well, and you feel that your business is going on very well. A day you get 1,000 every day, 1,000 every day in your business which you've put outside there. You've rented a house, right? You're paying someone to work with, okay, and you're getting 1,000 or 2,000 in a day, and you're very much satisfied. That's $20. You're very much satisfied. Now, let me ask you a question. When you come to Forex trading and you have got $1,000 and you deposit it into your account, you have a leverage of like 400. Okay. What is your target now at that point? We totally go out of way. We become unreasonable, such that even even a $50 profit is not even enough. You get $50 today, you still want to get 100. You keep on chasing the trade. You've got $80, you want to get 200, and you've got the same $1,000 that you would be realistic when you have a business outside there. Yeah, you would be realistic and wait for 5,000 a day. But when you're trading Forex, now this is where you can multiply all your money, and you want to make like 50,000 in a single day. That is the mistake that we do. You should have a percentage and let it be a compounding kind of a thing. If you are able to get like, just imagine this is a business like in other outside there. All right. When you get a loss, it's like outside there where you're paying for like rent and paying for the workers. All right. So in this case here, consider this one as a business as well and have a growth goal. Are you targeting for $10 in a day or $15 in a day? And you have a big account, yes, and you can comfortably make $15 or $20 in a day. Get satisfied with that. If you make your $10, maybe consider reducing your risks to a very low amount if you must enter another trade. And over time, you can see you can maintain, you can be consistent with a small profit, right? Which is not a very big percentage of your capital, right? A very small percent, but over time you become consistent, right? What is your risk reward? Again, how much are you risking? So all this goes into your risk management. How much money should you risk on individual trades? When you enter a single trade, how much can you start watching draining down your account? Most of us, we will ignore. Most traders, we have that. It's common, and no one wants to see a loss. Whenever you see a -3, for example, -$5, and you're imagining, well, it might reverse back. You leave it, it goes back to $2, all of a sudden up to $5, -$5, -10. You have all that confidence or that patience to wait for losses. That's not good. You should have a level of loss that you cannot withstand. If you have a $200 account, for example, and your rule is that you should not risk more than 10%. 10% of $200 should be, is it $20? If you get a loss bigger than that, then you're out. You must have rules. Your risk reward. Okay, and if you get a reward of like, if you're looking for a double reward, you risk 20, double reward will be 40. Sometimes you get 40 and still you'd want to ride the trend, maybe use a trailing stop, but make sure you can book your profits early or protect your profits. So another thing, how much money should you risk on individual trades? Position sizing, how much lots, how many lots in your trade. Okay, again, leverage comes in play here. And greed, control greed by knowing how much are you risking per trade, what's the position sizing. Because we try to imagine, if for example you have a trade and you put a mini lot, a micro lot of 0.01, it goes so well. And this is a problem for the experienced traders, or those who have been having a very nice working strategy, and you've been trading very well with discipline with a 0.01, 0.03, 0.05, if it goes far, all of a sudden you realize you're consistent. Now you imagine if I've been putting a 0.01 and getting $5 every day, if I put a 0.2 or a standard lot, now I am, instead of getting $5, it will be 50, right? And you don't want to take into account how big is your account, is your equity. If it is aligned with your equity, well and good. But when you think of increasing your lot size, consider the risk, all right? Always consider the risk even before the reward. It will help you. This is all about your risk management. What amount of leverage is appropriate for your account? By default, FXPesa will offer you 1:400. If you're okay trading with it, of course, it enables you to trade with a smaller capital, right? If you don't have that leverage, you may not be able to trade with a smaller capital. You might be required to deposit more money into your account, right? So it's helpful there, but again, it increases your risk, all right? So if you don't know how to use it, it's like a double-edged sword, just like a knife. You have a knife in your kitchen, it helps you. If it's very well sharpened, it helps you to prepare your groceries or your vegetables when you're preparing them. But wait a minute, if it just misses, it goes through your finger, you can imagine the pain. But is it bad? Do you throw away the knife just because it just slipped and you just cut your finger? You don't. You just use it more carefully next time. That's the same case with leverage. It is good. You can trade the smaller capital. It can increase your profits. But again, if you misuse it, it's going to be very painful on you, right? How many trades in a day? Sometimes you want to know how many trades do I need to place in a day, because there's another mistake called over trading, right? If you don't have these rules as part of your trading, you're going to overtrade. How many trades should I place in a day? If it's 3 trades and maybe you've done your 3 trades, you've been getting profits in all your trades, then you're tired. Take a rest, right? If you've placed your 3 trades, you've got losses, and there's that feeling you want to get back and recover, keep on trading up until you recover. You are going to mess up everything. Leave it. Tomorrow is another day, or next week is another day. How many trades in a day, right? What is your startup capital? How much should you allow yourself to lose, right? What is your goal? How much are you targeting in a single day of trading, or in every trade? What is the reward to the risk that you're targeting for? How much are you risking in a day? What is the position size? Very important, and watch out for your leverage. It's very important in your trading. So money management and risk management, you need to watch out for that. Now, here becomes something very tricky, and people don't really consider this, or traders don't consider this. Mindset or the psychology. This is very, very important, in as much as your strategy is important and your risk management is important. Your mindset, your head, your brain controls everything. All right. If you lose shape, you lose everything. If you lose your focus, it's because your brain is, or your mind is disrupted. You can't focus. Your mind is the #1 asset in this trading, because if you can't keep objective, then you will lose everything. You can't see the loopholes. You can't see the mistakes you're doing, right? So #1 thing is try to identify your mistakes. And what is going to help you to identify your mistakes is keeping sober in your trading. So first of all, what motivates you in your trading? Did you come in because you saw a friend was doing it and you didn't want to know how much they have put into it? You just maybe expecting to be making as much stream of income as they are making. What motivated you to get to trading? Because you want to get to trading when you really want to give it some time to learn. You want to get into the process, learn, understand that when you're starting, of course, you have to make some losses. You need to be in terms with that. You have to make some losses. And over time, that's when you're going to understand a trading strategy, right? And you're going to allow yourself to be led by someone to show you, right? And you're going to obey. You're going to learn how to be disciplined. What motivates you to trading? If you're coming to make money quick and be rich quick, then be ready to suffer a little bit of accounts getting blown very fast and you've lost of your capital, or you are putting a trade and then you keep on fighting, uh, keep on, you want to pray that that trend goes back and you start making profits again because you're in big losses, right? So what motivates you into trading? Make sure it's something that you're looking forward to. Sometimes I would advise you, let it be that you're getting into trading to earn a stream of income. All right, earn a stream of income, not to get rich quick. Okay, track your performance. This is very important. Keep a journal, and this is possible if you have fewer trades that can be manageable. All right, keep a journal. If you have got 5 trades in a day, try to document them. You entered at this point. Of course, sometimes it's good to enter trade. Before you enter trade, you have noted your entry, your exit. All right, entry, exit, stop loss levels, take profit levels. All right, you sometimes you want to note them somewhere and keep a journal. How many pips were you targeting? Did you get them? And what went wrong? Okay, and with that, you're able to know when I place the first trade I place, for example, is likely to win, and the subsequent trades that I put are the ones that draw down all my profits. So if you're able to learn your pattern, or for example, when I place a trade, the first one I place, I lose. The second one, I will always make a profit. You try to learn your trend until you understand yourself. Which is the best time? Is it when I'm starting when I'm starting my trading day? Is it when I get the best setups? And then that's what you should capitalize on, right? Or do I do better when there are news? Or I don't do well because there are news and I don't know how to use news very well. So you get to understand yourself and you want to you zero in into understanding yourself in your trading, because that's where we miss out on. So keep a journal. What is the maximum drawdown or profits you should hold in a trading day, for example? A journal will help you understand yourself. How much time do you spend trading? Again, if you find yourself like spending the whole day on the charts, trust you me, you can get tired. We are human beings, we get tired. If you're using a lot of charts, a lot of indicators in the chart, you're trying to consume a lot of information, you're suffering from analysis paralysis. Sometimes you can be tired. It's all about your mindset. Safeguard your mindset in trading, be objective, it can be very easy for you. What is your attitude to profit? This one is very important. What is your attitude to profits or losses that you take in the market? This is a business. You need to appreciate profits the same way you appreciate you need to appreciate losses the same way you appreciate profits, because this is a business. There's no business which doesn't suffer losses. All right. What matters is, as you're getting losses and profits, which one are more? Profits should be more. So you should work on your strategy to make sure that the profits are a little bit higher than the losses. And there are 2 ways here. You can either look at the win-loss ratio, right? Win-loss ratio. When you put it, for example, you have 5 trades. You have 5 trades. When you put all of them, all right, how many are you likely to get, even if you've got a lower risk reward? And how many are you going to lose? That's one way. Or maybe you will put a few trades and you will lose fewer times, all right? You lose fewer times, but then when you get that one single trade correctly, you ride big profits. Risk reward. So there are 2 approaches to that. You can always work with them to know that which one works better for you. So just to repeat myself, Your trading plan should include a trading strategy, tells you where you should enter trade, all those type of things, risk management, and how you can control your mindset. Those key points are very important. And this is what will help you to overcome the fear of missing out. I'm recapping, yeah, because when you have a strategy, a plan with a good strategy, risk management, and mindset, you know yourself, you not depend on anyone, you have your goals, of course, with your risk reward, you have all the knowledge that you need in the market, you always know your trading strategy will give you an entry and exit. So you won't become impatient. You have to wait because you've tested over time and you know the best point of confirmation for you. And you have a way of getting the signal, and you even know that this market is here. It's not going anywhere. You can always jump onto another trade even if you miss one. You can't get everything. All right. Confidence trap. You know you can always check your emotions and control them, and you won't erode your confidence over time. And that's what will help us sail through the fear of missing out challenge. Now, I want us to look at the perspectives of FOMO. Of course, fear of missing out is a concept which can be applied widely. Fear of it's even in marketing, and it can be used positively, right? You can watch out there and you see in the media, it's like if someone is doing it, why can't you do it? All right, and people get influenced to do things or buy products or want to feel as good as others who are using the products are feeling. Well, that can be a positive or negative. But for us, let's look at the positive perspective of fear of missing out in forex trading. It's a psychological exploit. It affects our psychology. Remember, if you can mess up or if you, whatever you feed into someone's psychology or mindset is likely to affect their performance, even in forex trading. So in forex trading, we want to focus on the positive side of the fear of missing out and create a balance. All right. So don't be left behind, kind of a mindset. Don't be left behind. Right? Yes, someone is getting profits, they are riding waves. Okay, there's no problem. It's the same markets. Learn new tricks, okay, so that you can as well get into the market. Set reasonable goals. Someone is making profits there, yes, of course, but you can as well use your system to make profits. Have a plan, your own plan, not using someone else's plan. Of course, don't be left behind, but have your own plan. Work on a strategy. Don't depend on someone else's strategy, right? Maybe you can use it to give you more confirmation, but don't be left behind. Have yours as well. Keep your journal. Learn yourself. Understand how you trade. Where, which are the tumbling blocks in your trading? Is it that you win so much and then you get overconfident and all of a sudden you increase your lot size and you draw down everything that you've gotten in the process, and then you all of a sudden you get in this confusion of feeling bad. You want to start breaking something or feeling bad. Keep your journal, learn yourself, control your emotions, trust the process, because everyone keeps on working on their progress in trading. All right, everyone starts by losing in the market. Actually, you start by not knowing what a demo is. You start by not knowing what a financial instrument is. All of a sudden, you get into it, you start practicing, you form your trading strategy, you start losing your trading strategy. But as you keep on progressing, you get hold of it. Trust the process. Don't be left behind. Keep getting better, because everyone keeps on building on what they have already. But of course, getting information from others, seeking information, attending webinars, following someone to see how they trade. But don't forget what you have. Don't forget your goals. Don't be left behind, but remember to be in charge. All right? Let others advise you, but not decide for you. Maybe you've had this one outside there. Don't follow the herd. People might be making profits. Remember, sometimes people might be trading the markets in the wrong way, but they're making profits. Well, that's their way. Find yours. Don't follow the herd. Before you take a step, make sure you know why you're taking it. All right? Make your decisions and learn from your mistakes. Be in charge. So, positive perspectives for FOMO. Don't be left behind. All right? You must allow yourself to keep pace with others as well. If they're making profits, look for your own ways to make profit as well. You're in this market to make profits. But even as you're getting that influence, be in charge of yourself. And my last word here is plan your trades and trade your plan, right? Be humble and always give back. When I say be humble and give back, is when you've learned a trick, you know how to trade. Don't be mean with it. Don't be mean with information. Give information out, right? Of course, that one won't affect the way you're making profits, right? And then good luck, all of you. You know you're trading. So let me hear your questions, ladies and gentlemen. Let me hear your questions, what you've not gotten well, right? You can type your questions on your checkout on your control panel and ask questions. All right. Someone asking how much should you invest? Depends with how much you want to target yourself. How much do you want to be getting from trading? All right, it's very important. Psychological aspects. Stephen, although Stephen has left, you're good in analyzing, finding the perfect entries, but emotions and indiscipline causes me. Now you have to form your rules. Sometimes you are advised to write down something. Put down your rules, write it. Sometimes you want to help yourself in a very crude way. When I say crude, it's something which doesn't seem very good or it's very easy to do. Like for example, if I tell you to write a note, like a sticky note, and put it somewhere, and you're following it, it seems like it's very crude, but it's something which can help you. So try to, if you have to write down your rules, put them down and force yourself to follow them, because there's no shortcut to that. You have to follow your rules. If you don't play by your rules, then nothing which can help you. So discipline, have to follow your rules. Recording, yes, of course. Albert is asking whether you can upload this recording to the YouTube channel. We will look into that. If you really like it, then you can do it for you to access it. You want a copy? So many are asking for the copy. We see what we do about it. All right, Paul, no problem. When someone is on, Meshach is asking, when someone is on drawdown but sees a potential pullback, you should close the trade or wait. Now, when you are on a drawdown already, it's a mistake, right? When I'm talking about a drawdown is, for example, you have $100 and you're already losing like 60 or almost even getting a margin call, right? And then you still want to wait for the correction. Yes, of course, sometimes you might wait, but remember you've made a mistake already because you've allowed yourself to go to a very big drawdown, right? Maybe think of adding more capital to your account, all right? And then try to hedge on that position. But allowing that trade to keep on running, okay, it's like sometimes it's like you've just risked it all and you're ready to lose it all. Okay, maybe sometimes you might want to get out and scale down on your, try to reevaluate your trading strategy on your lot size, or maybe add more money and trade carefully. So I won't advise you to keep on holding on a losing trade just because you see a potential pullback. What if it doesn't materialize, right? Sometimes we see so many potential setups in the market, but they don't happen. Okay, the market, maybe I've read about this saying several, that the market can remain irrational longer than you can remain solvent. So if the trade is going bad, that's why I said you should have red lines, that you have got a certain percentage you won't allow yourself to lose beyond that level. If your trade is going all the way to that level, get out. Okay, get out, analyze another one, because this market doesn't know anyone, right? You're the one who know yourself, and you have to control the losses. Control the losses at the right time before you get caught up in a very big drawdown you can't save yourself from. Good questions flowing in. Keep them coming. Examples of trading strategies. Well, I can't really show you the trading strategies here because We don't have that much time, of course, but we have them covered in one of our webinars. All right, we have webinars being rolled out to you. I just want to check them out and tell you the ones which are up. Next, we have trading strategies this Friday. Right, you can register for 6 p.m. Actually, trading strategies, you can get a whole like 2-3 of them. And again, for the ones who are beginning on Saturday from 10 a.m., we have got webinars. Go to FXPesa.com, go to the insights section and register for the webinars, and you can get all those insights on trading strategies. Good question. Philip, you're asking whether you have trailing stop. Well, remember, you can log into your account on the FXPesa Trader app, right? And you can even log into your account with the common MT4. Yes, we have the trailing stop. Okay, you can always set it there. But sometimes you see, you want, it depends with the way you want to implement your trailing stop. You might want to set it up so that it is automatically trailing, or you can yourself trail the stop. When your profit is above your, when the price is above your entry level and you're making profits, you can change your stop loss to go a little bit above the entry, and that's how you protect your profits. And it's also a trailing stop, right? But yes, you can use it on our platforms, especially if you're using the MT4 on your laptop. Gilbert, you don't know how to place a trade? Please make sure you register on our platforms, right? Have a demo account, register on our platforms, and register for the trading, right? We take you through the basics from how to read the how to check out on the various financial instruments, how you can place a trade and even close a trade, how you do the profits, and how you form your trading strategy, and the tools to use. So Gilbert, make sure you register, right? Have a demo account, and then someone will call you to direct you towards how you can get all through. Good questions. You want to get the presentation? Well, we look into that. We have several who are asking about trading strategies. Please join our classes, our webinars, which is for our webinars. We have a trading strategies webinar tomorrow at 6 p.m. All right, register for that one, and you can get more insights on that on trading strategy. You're asking about which currencies are good to pull back trade. Well, you see, pullback. Let's look at what is pullback. Pullback is when you had a price trending upwards so much or downwards so much, and then it takes a rest, pulls back a little bit before it follows back, or it gets back into the trend, right? So pullback is more of a scalping type of trading strategy, right? But any financial instrument, all the financial instruments have got pullbacks. Okay, so you just check out when the trend is exhausted and it's pulling back, then look where you can end up. But sometimes people trade the pullback differently. You want to check out when you're likely to see a pullback, and then you scalp that one. And it's always good if you're using the pullback method to get you to your trades. See how you can utilize the Fibonacci levels, because sometimes when the price hits there, when you have a full trend, it's pulling back. Maybe check out on those levels like 23, 38 points, right? That 8 level, right? Might help you to know where the price is pulling back to, okay? Or even 50 levels. So you can combine Fibonacci with the pullbacks and can help you, right? But any financial instrument can pull back. It depends with you. Different traders will prefer to trade different financial instruments. Some traders have got higher risk appetite, and you can go to very volatile financial instruments like gold, for example, like oil, right? So it depends, or maybe go to exotics, right? So your portfolio depends with you, but maybe guide you a little bit. You want to have a mix of different financial instruments so that you don't go for like a whole day without an entry opportunity or a trade opportunity, because you're trading, maybe looking up to the same financial instruments which are related. You want to have a portfolio of a mixed financial instruments, maybe some exotic here, a minor here with different currencies, maybe have some indices, a few stocks, and indices. All right, maybe 2 or 3. Again, don't have a very wide variety of financial instruments that you're trading, because it is going to erode your ability to focus on a few. So that's my word there. A pip, Judy, is the smallest movement in the price of a given currency pair. Right? The smallest movement of a price. Again, Judy, this is what we do in our very basic training. Right? Make sure that you join our webinars, especially the A to Z webinars. That's where we will train you on how to use the pips, pip value, and all those. And now maybe we check out on our register for our classes on Saturday, Introduction to Online Trading at 10 a.m. Saturday, this coming Saturday. Every Saturday we have those classes. All right. If you don't get time to attend that one, the next one we'll be having it on Wednesday next week. All right. Make sure again you can attend it, and you get all those basics. Good questions. Ruth is asking, between robot trading and manual trading, which is the best way? Well, robots are good to use if only you know how to apply them well, right? But if you have a robot, make sure you monitor it. You can't leave your account on the robot without checking out. You have to monitor it, okay? So a robot can be good if you've taken time to test it and see how best it works, and with which financial instrument and what time frame. Of course, you're given guideline when you get a good robot, all right? Well, trading manual as well is profitable because you've got more control. All right. So all of them are good. You just have to make your decision which one is better. So Larry, assuming you have X amount in your account, what reasonable percentage of return should I expect so that you don't get greedy? Well, a smaller percentage is a little bit more sustainable because it won't push you to excitement levels when you're making a loss. For example, if you have got $100 and you set your risk amount to 50%, which means, or maybe to 20%, which means every time you're losing $20, if you lose 2 trades at $20, then you've lost like half. You've lost $40 out of 100. You're remaining with 60. That's not healthy, right? And remember, the amount which you're risking again will push you towards using a bigger lot size. So I would advise you, don't risk more than 2%, or if you're of higher risk appetite, maybe go to like maybe 3%, depending on your risk appetite. And the amount which you're risking is what will guide you towards the returns. For example, you're risking like $20 or $5 in a trade. How many times are you looking to have as part of your returns in comparison to the risk? I don't know whether I'm clear. You risk $2. Are you looking for one to double that amount or triple that amount? Probably the lower the, if you have a reasonable risk to reward, you want to have like 1:2. Again, it's not fixed. It depends with you. But 1:2, a little bit, or even 1:1.5. All right, and it will keep you without a lot of pressure. Okay, and you can easily get your targets achieved. Using the lowest lot size, if a trade is past $5, how much can it's? I really don't understand what you're asking. But you have a $5, then keep to 0.01 lot size. Gideon, thank you. Thank you as well for being here. What news affect indices? Well, indices, remember, they are a collection of stocks, a basket of stocks. So you have got stocks in the tech sector. So if it's the technology sector, then you have to check out on the news that are affecting companies in the technology sector. All right. If it's maybe the consumer, of course, we have various sectors for different stocks. All right. You want to check out on the performance in a given sector. Right. If it's the tech sector, make sure you keep check on the news are coming up on the technology sector, and that one goes for all indices or maybe regions, because we have indices for various regions. For example, we have got Asian indices, European indices, and you have US indices. What is happening on the European economy will affect the European indices or European stocks. Remember, a stock are based on companies that are operating in a given economy, all right? So you want to make sure that whatever is happening in a given economy, for example, if it's Europe, whatever is happening in Europe is going to affect the performance of all the European companies there, and their stocks are going to be affected. So you need to be, if you're trading on the European stocks, then you want to be very well versed with what's happening in that economy. For example, a time like now, if you're trading indices, you want to know how is the distribution of coronavirus vaccines or COVID-19 vaccines in that economy. Do they have lockdowns? Of course, if they have lockdowns, it's affecting the performance of the economy, affecting the performance of the stocks, and then of course they're going to be going down or trending downwards. Those are the things that you're going to consider. But then, of course, you need to check out on the technicals, because especially moving averages, they will show you the movements of those stocks or even indices. All right. If you don't have any more questions, ladies and gentlemen, it has been a very, very nice engagement with you. I've answered quite interesting questions here, and my word is, if you're starting up now, make sure you get the right education and practice. Trust the process. For you to avoid all those aspects that will lead you to fear of missing out or getting the wrong influence, make sure you get the right education. All right, get the right education, work on your progress, believe in yourself, keep on improving, and most important, have a trading plan. In as much as you want to have a trading strategy and manage your risks and control your mindset, or try to watch over your mindset, then make sure you put all that in a trading plan and trade your plan. Okay, trade your plan, keep on making better. So Olivia, we have demo accounts. All right, that's where you will practice for free. Okay, that's why you practice for free. I don't know if that's what you were asking about, but make sure you register a demo account and practice for free, and we will lead you, we will help you in learning. But if you're concerned about the margin and you don't want to use the margin, of course, you can always set your own leverage. All right. So, ladies and gentlemen, thank you so much, and see you next time when we will be speaking about demand and supply. Remember, these Thursday webinars are here to keep you mentored, to give you more information. It's for all the traders, whether you are experienced, whether it's your very first time you're trying it out. This is going to help you to be better in your trading. Thank you so much for taking your time to be here. Keep getting better. Trust in the process, and all the best. Good luck.